This is Robert Kraft, and I'm your host on SNN.Network. And with me today is a very familiar face to our show, and I'm so thankful he's taking the time because I'd love to hear his reaction to what a day and a half it's really been. Rick Rule from Sprott Global, Sprott U.S. Holdings. Rick, great to see you. How you doing?
Fine, Robert. Thanks for having me on. Interesting days, as you suggest.
Interesting is a key operative word, I think, in our financial industry at this point. First things first, let's get your reaction. It's been a volatile couple weeks. I know we only had you on like maybe a month ago. It literally seems like that was 5 years ago. So let's get your reaction. You know, what are you seeing? What's going on?
Well, a lot's transpired. Mercifully for me, I remember that interview fairly well. I talked about buying high quality stuff and staying liquid, which turns out to be very prescient advice. Even, of course, the high quality stuff sold off. One thing that you'll note in financial panics, and by now I've been through several of them, is that like the old movie, the good, the bad, and the ugly all get sold off. Today, as an example, you're seeing very aggressive selling of gold as the leverage long CTA accounts, the commodity accounts, which are sometimes leveraged 30 to 1, hit margin calls. Every asset gets sold off in a crash, and that's certainly happening here.
Well, I got to ask, and because listen, I'm not sure if you have a tattoo of this yet, but we've interviewed you enough times where you said, bear markets are the author of bull markets, and bull markets are the author of bear markets. So I got to ask you straight on. I mean, are we in a bear market right now?
Oh, absolutely, absolutely. I think that we are coming into an oversold bottom. In other words, I think there will be a recovery from the levels that we see this week and perhaps next, because you will see a cessation of margin-related sales as the most aggressive disposals take place. But I think we have shaken faith in the system. And I also think that the liquidity additions, which were announced today by the Fed, were probably already largely priced into the market. My suspicion is that it will take a while to restore confidence, and confidence will be very slow to restore if the economy, rather than merely the equities and debt markets, take a hit. If economic activity slows down and earnings slow down, rather than merely the perception of the value of those earnings as expressed by share prices take a hit, we could easily be at the end of this 10-year-long recovery. When I was your age, we expected bear markets to follow bull markets. We used to have these things that they don't teach about anymore called recessions, which is where tightening credit conditions cause an economic slowdown. And there were consequences of actions in those days. People lost jobs. People's homes got foreclosed. Things that we haven't seen in large measure for a long period of time. I hope that doesn't happen this time, but it's certainly something that people need to be prepared for. We've said in our interviews before that although I'm not an economist, 10 years is a very, very long uninterrupted economic recovery. And at least in the historical context, this one was very long of tooth. One nervousness that you have is that the tools, the fiscal tools that were available to us, lowering interest rates, are increasingly less available to us. I understand that they can take interest rates negative, and they can continue to print. What happens is that the amount of stimulus that you generate relative to the amount of liquidity that you add diminishes over time. And we may be, I'm not saying that we are, but we may be in one of those periods of diminishing returns where the ultimate consequence is a crisis in confidence. And that could be fairly long lasting.
Absolutely.
The truth is, at your age, different than my age, you need to recall that the ascent of man is a great, great, great bull market. And when things look their worst, they're setting themselves up to be their very best. You will be able to buy pieces of business. That's what stocks really are. At prices that will serve you very well for the rest of your life at some point in time in the not too distant future.
So I have to ask, as you said, you've been through a few of these cycles, and you've been around some of these. You've experienced the R word. By R word we mean recessions.
Sure
So in times like these where you're seeing 7% drops. I mean, right now as we speak, we're at 6%. It was 2,200 points off the Dow earlier. Gold even down. What was it? $40, I think it was today.
Yep.
Just dipping under 1,600. What do you tell investors then, or what have you been telling your clients and investors, saying, hey, here's what's going on. Here's what to do.
Sprott has a couple 100,000 customers worldwide. And so there's no one size fits all piece of advice. This is going to make me sound like a real California lotus eater or maybe a pot smoker. By the way, I'm neither.
Lotus is
but
good
the essence of wealth is enhancing your sense of well-being. If you are nervous, raise enough cash that you aren't nervous. The answer really depends on you. For myself, I came into this in a very heavy cash position. It wasn't so much a strategic move as the fact that I was having difficulty finding bargains that suited various parts of my account. So I have a laundry list, a shopping list of positions that I'd like to add. And I have been tiptoeing into this market. For the clients who followed the advice that I gave on your show a month ago about buying the high quality stocks, where we took half positions, what we're doing to fill out the rest of the position that we'd like to take is we're selling puts. We're selling short dated puts. And selling puts or puts and calls around core positions when the volatility index is above 20 is usually a very good strategy. And the VIX today is about 50. It's well above 20. So the idea that let's say you want to buy a company and you think that $20 a share is a fair price for that company, you might be able to sell a 17.5 put, give somebody the right to make you buy within 90 days for $17.5, a stock that you'd be perfectly willing to buy for $20. A couple things happen. You either get the stock $2.50 cheaper than you were willing to pay for it, or you collect the premium, which could be $1, $1.50, and just walk away. Those are very good strategies when volatility is high and pessimism is also high. So we have been suggesting put selling strategies to many of our newer customers that don't have a full complement of high quality names.
Got it.
The one caution, and this may be anticipating a question or maybe it isn't, the one caution that I would give your listeners is my suspicion is that there may be another credit shoe to drop as a consequence of the really precipitous decline in oil prices. The U.S. oil industry has been a very profligate user of low-priced credit. And this, I think, will cause problems for regional banks and money center banks. But I think it could cause bigger problems for the junk bond market. I read on Bloomberg that 15% of the publicly traded junk debt in the United States is oil and gas related. There's two problems with that. This subordinated or junk debt is going to be much more difficult to service at $35 oil than it was at 60. But the second problem is that an awful lot of this junk debt is now owned by high yield and junk ETFs, exchange traded funds. These funds are extremely liquid, but the underlying assets that they own, the junk debt issuances, are often very illiquid. And if we have a circumstance where individual investors who were attracted to these funds by the yield become afraid of the credits or become afraid of the energy business and go to sell or redeem the ETFs, the managers of the ETFs are forced to sell off the underlying asset to service the redemption request. But when the demand for sales is high, all of a sudden the underlying assets may become unsaleable. I remember in the junk bond crisis that followed the collapse of Drexel Burnham years ago that we had a phrase called an owl bond. An owl bond is when you called your broker wanting to sell it and your broker said, "To-hoo, to-hoo." And while that's funny, the potential for disintermediation in these income ETFs has the impact of a sort of a run on a bank if it occurs.
Right.
I'm not saying that this is going to occur, but I think this is a circumstance that investors and speculators need to look at in terms of timing an aggressive entry into the market, particularly if, as for myself, they're looking at beginning to make some energy investments in an oversold market. You might want to wait and see how that credit thing works out.
Right. I mean, speaking of which, I mean, we've every interview, you focus on, or Sprott focuses on natural resources. So I'm assuming when you're talking about high quality companies, I'm just assuming you're really looking at some of these higher quality businesses in the natural resources space. So with everything that's going on right now in this market crash, I mean, what are some of the things that you're looking for that investors should also be looking out for?
Well, again, it depends on the investor.
Of course.
We have found most investors under-own gold as an asset class to begin with. And we like to start people in gold positions with gold, preferably, of course, Sprott gold. We would prefer that they bought the New York Stock Exchange traded product sponsored by Sprott. And then the higher quality gold stocks. Too many people who are interested in gold have portfolios that are too speculative. I'm not saying don't speculate. All the money I invest now, I made by speculation. But the truth is, a gold equities bull market is so dramatic that the idea that you go for the riskiest names to outperform the market ends up being pretty stupid, because the high quality names do astonishingly well in a good market and expose you to less risk. So we like to start people with the very high quality names. This isn't investment advice, but names like Franco-Nevada, Wheaton Precious, Barrick, Agnico Eagle. If you're a little more aggressive, Newmont, where the cost structure is coming down. We would suggest beginning exposure with very high quality names like that, and perhaps getting that exposure by selling puts, or buying the stock and selling both puts and calls around core positions, short dated puts and calls, 90 days or less, when the volatility index, the VIX, is above 20.
Got it. And real quick, just to for full disclosure, do you own shares in any of the names that you just mentioned?
All of the names I just mentioned.
Cool. So then, moving forward here, what would be your overall outlook? You already kind of mentioned it a little bit in some of the potential things that can happen, and that can explain why things potentially might get worse than they even are right now. But overall, having been through, a few of these cycles, what do you expect to see coming up in the next couple months here?
Oh, next couple of months, I think, are going to be treacherous. I think they're going to be really treacherous. We're in uncharted territory. We had a black swan, the coronavirus. I mean, 2 years ago, that was a beer brand. It wasn't a bug. We may have another black swan in the offing. 2 years ago, the best credits in the world were energy credits. And so if we had a credit crisis in energy credit, on top of the problems that we're already having, uh, this could be, I'm not saying it's going to be, but it could be a real character building event. The truth is that life goes on. The truth is that 5 years from now, when you go to the garage, turn your key to the right, you're going to want the car to start. And that means that there'll be a market for oil and oil stocks will come back. Life will go on. I'll give you a wonderful example, actually, of past bear markets. I've done this in numerous interviews, but I began trying to diversify my own portfolio in the early 1980s. And the first major stock I bought was Berkshire Hathaway, because I didn't think I could outcompete Buffett as a stock picker. And I figured out that having his portfolio in an insurance wrapper meant that despite the fact that he said I should pay more tax, he didn't have to pay much tax, which I thought was a great advantage. So either 3 or 4 times now since I've owned Berkshire Hathaway, it's fallen by more than 40% over an 18-month time frame. And every time that you experience a 40% decline in what you think is your safest possible stock, it's disconcerting. But the truth is, if you look at the Berkshire Hathaway stock chart in the period 1982 till today, Robert, you can't see those 40% declines. So it's important that when people go through what they're going through today, that they understand that life will go on and their life will go on. The most important thing to do is to prepare yourself. Be in shape financially and psychologically to weather the decline. Always have cash, even if the purchasing power of that cash is declining as a consequence of Fed actions. If you have cash, you weather a circumstance like this. You take advantage of it rather than being taken advantage of by it.
And with that, Rick, where can my audience go and find more information about you and Sprott?
Well, as usual, I'll make your audience an offer. And the offer is this. If your audience will email me at rankings, rankings, at sprottglobal.com, if they include their natural resource stocks in the body of the email, not as an attachment, but in the body of the email, both the names and the symbols, I will rank those companies 1 to 10. Not investment advice, I'm just ranking the companies in their current market conditions, and I will comment on those companies where I think my comments have value. I will also, if your readers ask, include 2 stock charts, one being the Barron's Gold Mining Index, which is the longest running gold equities index on the planet, which will show you just how cheap these things are. And the other is a 100-year commodity index, which will put where we are in this market in context going back over 100 years. So once again, 2 charts and rankings by emailing me at rankings, rankings, at sprottglobal.com.
Perfect. Well, with that, Rick, always appreciated. Thank you very much. And look, man, stay safe.
My pleasure. Enjoy this. That's all you can do.
Take care.
Bye-bye.